Welcome. Thank you for tuning in as we do our second video in our continuing video series. The subject of today's video is how we protect our investors that buy our mortgages. These mortgages, when they're originated or created properly, are very low risk, and we're going to show you why. Some of the benefits that you should know are the typical yield to an investor always ranges between 8.5% and 9.4%. That's payable monthly, that's a yearly yield. The length of the investment varies. Can be as little as 3 years and as long as 10 years. The typical size of the mortgage ranges from a low of $25,000 up to $200,000 typically, and sometimes more. Those are typical margins we deal with. Main points that we're going to talk about today: funding the loans with our money, managing the loan to value for that particular customer, the 5 C's that we use to score our borrowers in order for them to qualify for the mortgage, business borrowers and why we only use business borrowers, talk about collateral property, which is of utmost importance, and then some of the agencies we use to investigate our borrowers: federal agencies, state agencies, and local agencies as well. Another exclusive that we have here at Mortgage Investors Network is we have a clause in our assignment agreements, or that's an agreement to sell a mortgage, where we have the first right of refusal to buy that mortgage back from the investor, should they choose to. And lastly, we'll go over the advantages of our investments. When we fund a loan, we use our money. We're not using a credit line with some big bank or anything like that. We're using our own money. Because of that, we'll never put profit first. It's utmost important to us that that's a quality mortgage. There's no guarantee that a person's going to purchase our mortgage, so we got to make sure these are viable borrowers that make their payments on time. We have invested not only our money, but we've applied over 30 years of experience before we say yes to a mortgage. Maximum loan to value in any circumstance is 55% of the value of the property. All our mortgages are first mortgages, and now in certain cases we approve the loan at less than 55% loan to value. Here's a couple of the examples. Lower value properties. Let's say in our county it's less than $100,000. We'll typically cut the loan to value lower than 55 because the actual dollar amount of equity in the property is much smaller. We can't always use percentages. Sometimes we got to look at the actual dollar amount of cushion that we built into the loan. Unusual properties. These are properties that may not be as marketable as a single family home or a triplex or a duplex. So when they can't be quickly sold because of their unique qualities, which sometimes deter lenders from financing them in the first place, we have to be more conservative when we do the loan in the first place. Property condition, obviously, if the property is not in good condition, we either loan the money and bring it up to speed, or we turn the loan down right up front. Neighborhood trend, also important. Very often you'll run into situations where a property doesn't fit in with the rest of the neighborhood. Now, the fact that it's somewhat unique can be a detriment when it comes time to sell it. So we take that into consideration, and very often we'll drop the loan to value. Other mortgages that we do, sometimes when a borrower comes to us, doesn't have enough equity in the property in question, they might have other properties that are paid for. We'll take that other property and we'll include it on the same mortgage, which will get us the loan to value we need. We call those blanket mortgages because that's more than one property on the same mortgage. After repaired values, that means that the property in its present state, it's not its highest condition or usage. So very often we will have the property appraised as if it were repaired, and then we'll escrow funds, usually the borrower's funds, to make sure that money goes into that property to bring it up to that level that we need. Also, another technique we use, if a borrower comes to us and does not have sufficient equity, then we'll ask the seller, if it's a purchase loan, to hold a second mortgage. either long-term or short-term. 5 C's. We've talked about this before. We actually have a scoring system for 5 C's. Character is the first on the list for a good reason. The amount of respect that a borrower shows for the borrowing process is very important. Examples of negative variables would be the borrower has plenty of income but doesn't make his payments on time. That shows a disrespect for their own credit and a recklessness when they go to borrow money because they know they're going to pay higher rates. Sloppy paperwork. We talk to people every day applying for loans. If they are incomplete, inaccurate, that does show the amount of respect they have for the process. Exaggerations, very often they're trying to influence us with exaggerated figures, but all that does typically is makes us more curious and we dig in a little further. If it's complete exaggeration, we just turn the loan down. And when you can't verify a situation, you obviously can't do anything with it. So those are very important factors. Credit must be reasonable. People from time to time might miss a few payments. Not regularly, but on an exception basis. If slow pay is a habit, they don't get their mortgage. Extraordinary event, that can happen. When I say extraordinary, it's usually high dollar. I've seen situations where a person had $300,000 or $400,000 worth of debt. Something tragic happened, whether it's medical or death of a spouse, and they took a Chapter 11 bankruptcy where they pay everybody back. That is an extraordinary event. Matter of fact, we have a loan on our books like that because that goes to prove what that customer does when they run into a problem. Now, do customers borrow money for business purposes, which make their financial situation stronger? Or do they borrow money for luxuries? Do they have a average income with a much higher than average lifestyle? Potential problem. How often do they borrow? That says it all in itself. Now, if a problem with credit is there and we see that, we look to see, is it fixed or is the root cause still there, which is going to cause them eventually to borrow from Peter to pay Paul, so to speak. Circumstances is another one of our 5 C's. Borrowing for business purposes is what we look for. That will or should make their situation better. The business that they own, the rental homes that they own, whatever the case may be, borrowing money should move them forward. And the next two are somewhat related. Is the request realistic? If the person doesn't have enough experience and they're taking on too much at one time, in our estimation, and it appears that the odds are showing us that they're doomed for failure, we could potentially have to either restructure the loan, cut the loan back, or tune it down altogether. That goes along with unrealistic expectations as well. Also, the industry. The industry is important. We always look to see, is this industry on the upswing or the downswing? The 4th C in the 5 C's is capacity. That's the capacity of the borrower to make their payments, both in good times and bad. What's important about that is when you figure income over debt, it creates a debt ratio. But like any ratio, it doesn't tell the whole story. The amount of money that's actually left over after they pay their bills is what's important. That is what sees them through tough times. This COVID-19 virus period that we're all going through is a perfect example of that. If a person has a 20% debt ratio, it looks good on paper. But with a $25,000 income, the amount of money that's actually left could be insufficient in the event they lose a couple months worth of income. If a person has a 40% debt ratio with $11,000 income, the amount of money that's left over is a sizable sum that can weather them through the storm. So you have to look at ratio and dollar amount. Also, it's important, do they have any net worth? Do they have any cash in the bank? Do they have any investments? Maybe some cash value in life insurance. Maybe they've started a 401k or an IRA. Maybe they have a couple more properties that they own or they're paying for. These are all what we call secondary means of repayment. The last C is collateral. We're going to go over that separately because that's very important. Business borrowers. We loan only to business borrowers in most cases, with very few exceptions. One of the reasons is the compliance threshold of paperwork that needs to be met is much lower for the business borrower. And the reason really stems from the regulator's viewpoint on the matter, which is business borrowers should be more aware of the rules. We agree with that. We find that most business borrowers have a much better understanding of financial situations, and they tend to actually pay their bills better in our estimation, because the debts they take on further their financial well-being. Another point that's very pertinent here is, in the event you do ever have to face a foreclosure, a favorite ploy that attorneys use when they're defending a debtor is to take a bankruptcy. Well, personal bankruptcies, as you probably already know, are fairly inexpensive and they're used fairly often. Now, business bankruptcy, because we're using business borrowers, is much more expensive, much more involved. So the likelihood that they will take one of these bankruptcies in our price range of the loans we do is proven to be very, very remote. So that's an added safeguard for us. Now, some exceptions to the business borrower is if a seller of a property holds a mortgage when the borrower buys it. It's called a seller-held purchase mortgage. Those fall outside of the guidelines, so we can buy those mortgages, or we can basically originate those mortgages from the seller. And it is an exception to the very strict regulations they have on personal borrowers. Our target market is small business owners. We're not looking for the $1 million loans. We're interested in the loan category between $25,000 as a minimum and $200,000 as a typical maximum. We've done more, but those are the typical sizes we deal with. Collateral properties. First of all, they're business loans. We're loaning to a business. That business can be an LLC, which is a limited liability corporation, or it can be a regular corporation, whether it's a full corp or an S corp. Okay, we do not loan to sole proprietors and trusts because those are viewed as people. Okay, a trust and a sole proprietor is considered people. Those we don't deal with. Loaning to a person only happens in very few exceptions, of which I've already explained. Properties that we would consider, a second home, no, because that could be part-time residence of the individual. The actual residence, no, unless it's one of those exceptions we spoke of. Vacation home, no, could also be part-time residence. But rental properties, yes, we do rental properties all the time. And it doesn't matter if it's a 4-unit, a 1-unit, a 6-unit, whatever the case may be. It's income producing property, and the mortgage that they take is typically paid for by the income that comes in. We do a lot of those. Also commercial properties. We do a lot of those. Raw land, we might cut the loan to value a little bit because it's not producing income yet. Okay? And hybrid properties. Say there's multiple buildings on one parcel of property, a commercial building or a couple of rental units on the same parcel. We call that hybrid. We can do those as well. We use a variety of different sources to investigate our borrowers. Federal, state, and local are important. A couple of the federal sources we use is what they call an OFAC check. That is through an office they call Office of Foreign Assets Control out of Washington, D.C. That centers on potential terrorists, people with multiple aliases, that sort of thing. AML, which is money laundering criteria, is always important. We always want to know where large down payments or where a person's money is coming from, and we investigate that. FEMA, which is Federal Emergency Management, is a good source for telling us whether a property is in a flood zone or not. State sources. Great state source is Sunbiz, which is the name of the website for Department of Corporations. That tells us a lot of information. The proper name of the corporation, who the managers are. We can read the articles of incorporation. We can read their updates, which they have to publish every year. Variety of information. FDLE is for Department of Law Enforcement, shows criminal history. Another good source is our local sources. Our local county court records shows all kind of information. It shows positive information like mortgages and satisfaction of mortgages when they're paid off. It'll show marriage records, but it also shows a lot of negative information. Liens from, say, municipalities or IRS, foreclosures, judgments. Gives you a lot of information that you wouldn't otherwise be able to get. County sheriff records as another source to see if your borrower has any criminal records. Google check, have to check Google. A lot of information there. And last would be, whenever we do a mortgage, we get a title search and title insurance from the attorney or the title company that we're using at the time. Finishing up here, our first right of refusal is used in our contract when a person buys a mortgage from us. Basically what it says is, in the future, for whatever reason, if you wish to sell the mortgage, we want to provide you with a bid to buy that mortgage first. Usually, when it's one of our own mortgages, the discount or the cost to the seller is minimal. Another option is the seller doesn't have to sell the entire mortgage. If they have a need for cash, they can sell payments. If they have 120 payments coming in and they need to sell 40 of them, we'll sit down and do some figuring, and they'll get minimal discount there too, because we produced the mortgage in the first place, so we're very familiar with it. Very good source of liquid cash if you ever need it. We have a lot of investors. They're always looking for mortgages. So in the event your life changes, or the investor's life changes, and they need cash, whether it's in part or whole, we always have people looking for them. So we'll be happy to accommodate you there. Advantages of our mortgages. As you might have started to understand, they're well documented. We keep track of everything, and we make notes, and we have digital records. It's low risk. Our track record says it all, and we will provide testimonials from our investors. That will be coming up very soon. I think the investment, it's safe to call it transparent. You can drive by the property. You can look up public records in the county in which it exists. You can talk to the borrower. You can look at his credit. You can look at his income. It's not very often you have something that's so plain to be able to actually investigate the factors involved. And it's got a return between 8.5% and 9.4%. That's an excellent return these days. The borrower will pay you directly, so you get monthly feedback when the borrower sends you payments. Those returns are monthly. We think it's an excellent addition to a person's portfolio. It's steady money coming in. It's the same each month. Once you make the investment, you don't have to look to see what the value is every month. It just comes in. It's a good foundation for your other activities. People have questions. We get them all the time. We stay in close touch with our investors for any question they might have. Never a charge. We're happy to help. And like I said, we have a large network of investors available to purchase your mortgage should you want to sell it. We have our contact information here, our main office number, okay to call after hours, we get them all the time, and we have our email, info@mortgageinvestorsnetwork.com. If you have other questions, you can use one of those sources, or we're going to be doing a lot of follow-up videos. As popular questions come in, we'll do a video on it. We're going to have videos showing our products. We're going to have videos with testimonials. We'll have question and answer videos. So follow up with us. We'll continue these videos in our Mortgage Investors Network series. Thank you for watching us today. We appreciate it here.